All right, welcome everybody to the live stream. My name is Kyle. Here with me, as always, Dan Frio on the right, and then we also have a guest today, Jaspreet Singh with Minority Mindset, which has I was going to say it was 1 million, but it's 2 million subscribers now. So Jaspreet posts all about markets, really pretty much every financial market, right?
Yeah, all things what I like to say is understand money so you can afford the extra guac.
Nice. Well, yeah, we're really excited to have you on today. And so if anyone has questions, just leave them down in the chat. We'll pull them up here on the live stream and talk about those. But I figured we might as well just jump into it so we can get to all the questions. I know Dan has his question list rolling.
Oh, I got a whole slew of them for you, buddy.
Yeah,
so
take
last time you were on, I was creating a thumbnail for this event. And it was like last time this year, I think you were on, and we were giving our forecasts of what's going on in 2025 and so forth. And I think we did pretty good on those forecasts. So that's why I was asking you on this time. I know you travel all over the world, so thank you so much for being on here with us again. Actually, just so you guys out there know, my kids actually found Jaspreet, and they watch his channel. They were learning about finances and everything, and then at the end of his videos, he does this little unique thing, and I'll let him do it on today's show when we get to that point. But thank you so much for joining us again this year. You have a bead on all the markets, and that's why I just wanted your take on it. You're not one of those ones that, you're a doom and gloomer, or you're not saying you got to buy this. You basically just tell it as it is, and that's what I love about you and your show, because you just provide the data, and that's what all we're looking for. So thanks again for joining us.
Oh, thank you, Dan. It's really an honor to be on. I really appreciate the kind words. And what I like to tell people is many people know me for Minority Mindset, but the funny thing about that is Minority Mindset is my hobby. Most of my time is actually running Briefs Media. Like, that is my full-time job. I'm the CEO of that. So in that, we publish financial news, financial research, financial education. And so that helps me stay up to date on things. And I just kind of talk about things and things that are interesting to me on the Minority Mindset show. But through the Briefs Media and Market Briefs newsletter, that's where we publish everything there. Oh yeah, you can see it on the screen here. Market Briefs is a free newsletter that goes live 6 times a week that breaks down what's happening in the financial markets. You can read it in less than 5 minutes every morning, and we have hundreds of thousands of investors that read Market Briefs every single day.
And I am one of them.
Thank you.
And that's where I get a lot of my data. I steal it from you. I think I did a video one day, and I sent you an email. I'm like, dude, I just used this caption on there, and you were like, instead of getting mad, here's the nice thing about you. You're like, hey, I appreciate you spreading the word. So that's what I really love about you. You just give it as it is, and you don't schmooze it one way or another. Okay. So now we're done with that part of it. Now I got some questions for you. Okay, so here's what I'm looking for. Some guidance into 2025. I'm working on my 2025 forecast, and the election's over, thank goodness for us on that one. And the Federal Reserve did cut rates a quarter percent. So I got just a few generics for you, and then we'll let you kind of take it from there. In 2025, here, I'll just start a conversation, I guess is the best way to put it. Like, I'll say for personally, I think the market is a little hefty in pricing right now. But with the Federal Reserve cutting rates, I switched a lot of my assets into, interest-bearing accounts, utility stocks or ETFs, financial ETFs, and things like that. What is your thought going into 2025 in the market shift from, we know the Federal Reserve's going to lower rates. Is it necessary or not? That was another question I would have for you. What do you think the neutral rate is? But just generically, what are your thoughts on the markets? And just for legal purposes, I'll say it this way: we're not financial planners. Jaspreet, he does the newsletters and so forth. But what we don't want you to do is don't trade on what we're telling you. All we want you to do is listen, take this into context, use it for training and educational purposes only. Do not trade or buy any assets or do any investments on what we tell you in today's show. Just use this for educational purposes only. Okay, so that gets us out of trouble. So now it's up to you.
Thank you. And one of the things I like to say is I'm not a financial advisor. I'm just a random guy on YouTube. But so here's what I would say. The first thing is, the concern that I have is that, say, a lot of people that are investing based off of election cycles instead of investing based off of being a long-term investor. And I think the first thing is I want to highlight that is if you are a long-term investor, what's happening in the White House does not matter. So if you're investing in the S&P 500, you're investing in long-term ETFs, index funds, mutual funds, who the person in the White House is does not affect things. We've done a report on this in Market Briefs and Market Briefs Pro that between 1944 to now, we have seen markets go up and down under Democrat and Republican presidents both ways. So markets go up and down regardless of who is in the White House. Now, if we get a little bit more granular, what we also found is that between 1944 to 2020, there's only been one election where markets went down the year after the election. Only one time that happened in almost those 100 years, and that was after the 2000 election during the year 2001. So 2001 was the only year post-election that markets went down after an election. Now, why do I say this? Because if you are a long-term investor, what's happening in the White House doesn't affect you. However, for those of you that are, let's call it a little bit more sophisticated investors that are a little bit more involved with their investments, the person in the White House can impact certain industries, sectors, and companies. So the United States economy is a little bit under $30 trillion. That's our GDP. Our GDP is a measure of all spending that happens in our economy. And if we think about what makes up our GDP, well, it's the spending that you and I do and everybody listening to this does. When I go to Chipotle, that's part of the GDP. When Walmart buys avocados, that's part of the GDP. But the number one largest spender in our economy is not Amazon. It's not Jeff Bezos. It's the government. So our government makes up, depending on which article you read, it spends somewhere between 20 to 30% of our GDP. So 20 to 30% of our economy spending is government spending. The reason why that matters is now the person in the White House can have influence on how that spending is done, and then that can actually affect certain industries, certain sectors, certain companies, certain stocks. And that's where if you are a more sophisticated investor, this is where understanding what I call a government shift can be beneficial for you to understand the opportunity. What do I mean by that more specifically? Because I've been talking in theory. Number one, Trump has talked about deregulating oil and gas. He's talked about deregulating financial services. He's talked about investing in the military. He's talked about deporting many illegal immigrants. That's good for private prisons. And he's also talked about investing in the Space Force and space industries. So why am I bringing this up? Because if 20 to 30% of our GDP, again, 20 to 30% of the $30 trillion economy that we have is controlled by government spending, and we know government spending, government regulations will be in favor of those 5 areas: oil and gas, financial services, military, that's defense companies, that's companies that are producing artillery and other things for the militaries, along with private prisons, along with companies that are involved in space. Those companies could benefit. But not every company is going to win, because now we know that those industries in general may be a little bit more favorable, have the ability to generate more revenue and profits. But this is where your financial education comes in, because some companies are going to do better than others. Why do I say that? Because some companies, some oil and gas companies, are going to be bad with their cash. They're going to run a inefficient business, while others will run a more efficient business. So the first part is to understand what are the shifts that are happening, like I just talked about, and then it's your financial education, and then it's understanding your goals. Because a good investment for me may or may not be a good investment for you, because you might have a shorter time horizon, you might have a longer time horizon, you might have a bigger risk tolerance, you might not want cash flow. I might prefer the cash flow. So everybody's risk tolerance is different in that sense. And all of these things create different types of opportunities. So now to answer that question of what is going to happen, well, my job isn't to predict what's going to happen. My job is to make money and continue to build wealth no matter what's happening, because every financially savvy person understands markets go up, markets go down. That is a fact of life. We could see a recession, we could see an economic boom. And the problem that so many people make is they try to bet. They're trying to now play blackjack, or they're trying to play poker. They're trying to predict what is going to happen and make a trade based off of what is going to happen next year. And that's why so many people end up losing money in the markets, which is kind of ironic when, if we take a look at the last 100 years, the stock market, more specifically the S&P 500, has grown by a little bit more than 10% a year on average every year for the last 100 years. So if the stock market on average has grown by 10% a year every year, despite the recessions, despite the market crashes, why are so many people talking about how they lose money in the markets? We all know somebody who says the stock market's a scam, it's a casino, it's rigged. The reason why is because people don't have the right strategy, and they're investing on emotion rather than financials. And I think that's the real key here, is you got to start by understanding your goal. You got to start by understanding your game, because if you're a long-term investor, you don't want to read financial charts. You don't want to read financial statements. You don't want to listen to earnings calls. Just invest into the markets. Invest in the S&P 500 every week or every month, and just let the markets do its thing. We will see a market crash. Keep investing during it. We will see it rain. Keep investing when it rains. We will see political turmoil. Keep investing when that happens. We will see markets boom. Keep investing when that happens. And that's how you build wealth for the long term. If you want to get more sophisticated, now you start to look for shifts in the economy. You start to look for shifts in the market. And that's where you can find more of those, we'll call them sophisticated plays, investments. But again, that takes more time, that takes more work, that takes more research, and that takes more investment psychology, which is not for everybody. And I want to keep hammering that point home. And I know I've said this 10 times. I'm going to say it at least 10 more times. It's not for everybody, because what's going to happen is markets will go up and markets will go down. And when markets go down, that's when people freak out. And you have a lot of people that assume that they are genius investors because markets have gone up. And the question is that what will you do when markets go down? And so, that's kind of the long answer to your question of how to kind of look at what's going to be coming in 2025.
That's perfect. And that's what we try to say, to a lot of people. We deal in real estate. And, it's amazing how so many people are saying, I'm not buying right now because, the market might correct 5-6% and I'll just wait for that time and whatever. And it's like, okay, but 5 years from now, 10 years from now, 15 years from now, if I ask somebody, how much they paid for their house 15 years ago, they probably wouldn't even remember, or what's the current value is today. That's what we try to educate people, saying, if you're not going to be in your house, and I even heard you say it a few times in some of the videos you had, if you're not going to be in your house, 5 to 10 years, don't buy. You'll never recoup the costs, because by the time you pay the realtor and all your closing fees to buy the house, and then closing fees and all that to sell the house, you'd have to make $20,000, $30,000, $40,000 just to break even. So that's a tough part for a lot of people to understand. Housing, you can't pick the timing. It's tough to pick the timing on that. So you hit it right out of the ballpark. That's what I did for so many years. I would buy stocks, and then I'm buying on the way up, and then the market crashes. I'm like, oh, you freak out, and then you sell at the bottom, and you do exactly what the normal investor does. Finally, after years and years of doing that, like I just have my kids, they either put money in the S&P or Berkshire Hathaway. That's it. I'm like, don't even look at anything else. Just put money in those and forget it. And because you can't time the market, but it's hard. How many people you're like, especially now, it's like Nvidia. I got to buy Nvidia. Well, you buy now, it's already up 2,500% in the last 3 years or so. It's tough. But
yeah, and it's really just, number one, knowing you and knowing the strategy. I mean, there's a lot of ways to go about doing it, and I think the mistake is people get caught up in what's exciting and what's attractive and what's sexy, and then they make that the bulk of their portfolio, as opposed to making that a speculative piece of their portfolio. And I think that's the game where you don't have to necessarily, like, here's the thing. You don't have to deprive yourself of the ability to potentially invest your money into something that's intriguing to you. But then don't put your life savings into it because you're taking on all that risk. You see, it's a risk and reward game. So like what I do is obviously my largest investment is my business, but if we ignore the business, then it's real estate and then it's stocks. Now within stocks, I have two different strategies. I have what I call the passive strategy, and then I have my active strategy, and it's about 50-50. So my passive strategy is every week money is invested into my portfolio of funds. So I have funds for the S&P 500, I have dividend funds, I have just a bunch of different types of funds that are that broad exposure. And that happens every week, whether the market's up or down. That is just that just happens, so I get exposure to the market and the economy. But then I am a bit of a weirdo, and I like reading financial statements, and I like studying companies. That's just interesting to me. It's not for everybody, but I like that. So then I have a separate, we'll call it, bucket of cash that I use to invest now in individual companies. But again, I know that this is riskier, and I know the pros and cons that can come with this. So you have to know yourself and know what's the right game for you, because some of you are going to say, I like cash flow, I want dividends. Some of you are going to say, I want fast growth. Some are going to say, I hate risk. And it just depends on what's
Yeah.
right for you.
Yeah, and a lot of people, like, I always thought I was, I just give me the risk, give me the risk, and then as you start losing money, you're like, I don't want risk, I don't want risk. So that's what happened to me. All right, so let's flip over conversations to the Fed. So the Federal Reserve, they're in control of all interest rates, and I think they have the CPI came out today. That number looked pretty good, and so do you think they tackled inflation at this point? And do you think that's, I know it's always in the rear view mirror that they're going to, monitor those things, or do you think they are truly going to the, just focusing in on the job market at this time?
No, I don't think they've tackled inflation at all. I mean,
I don't think
ask anybody who buys groceries.
Yeah, I'm with you.
Here's what has happened. Between 2019 to today, we have seen household income rise by approximately 18%. Reported inflation, again, reported inflation is about 23%. Grocery costs, reported grocery costs have gone up by around 25%. Car insurance prices have gone up by around 50%. Housing costs have gone up between 50 to 65%. And the S&P 500 has grown by a little bit under 100%. So what does that mean? It means household income has risen over the last 5 years, but it has not kept up with even reported inflation. And we all know that the reported inflation really doesn't give the real inflation that many people feel. But that's besides the point. Let's just focus on the reported inflation. So if reported inflation is around 23% over the last 5 years, and household income has grown by about 18%, there's a margin there. And the margin is how the cost of living has outpaced incomes. Now, the reason why the Federal Reserve Bank has declared a victory on inflation is because they're saying that now, as inflation, the rate of inflation has come down to 2.6%. That was today's CPI report, 2.6% annual inflation. We have won because we brought the rate of inflation down from 9% down to 2.6%. And if we take a look at the reported wage growth today versus inflation, reported wage growth is higher than inflation. That's why they're declaring victory, because the reported inflation rate has fallen. But that doesn't make up for all the past pain that we have seen over the last few years, because that means that still the average person is poorer today than they were back in 2019 because their incomes have not grown with the cost of living. And I'm not even touching the standard of living. So if incomes have grown to here and your cost of living has grown to here, then you're effectively poorer. And so now to say that the inflation fight is over because wages are rising faster than inflation today, the Federal Reserve Bank is hoping that in the next few years, we will see the wage growth continue to outpace inflation, which will then correct for what we saw over the last 3 years. But in order for that to happen, there's a few things that must actually occur. Number one, wage growth has to actually exceed inflation continually, and then it has to continue for years until we make up for that. That has not happened. And until that happens, the average person, the regular person, and honestly, not even the regular person, everybody. I went to buy a few things of groceries yesterday. I bought 2 bags of groceries, and it cost me $101. And I looked at my wife, and I was like, I can't believe, how much $101 of groceries can buy. I mean, I'm not saying this to really pick sides. It's just the reality is things are expensive, and so what do you mean by winning the fight on inflation? Yes, the rate of inflation has fallen. That doesn't mean that the prices of things have fallen. That means that the prices of things are falling less fast. But I want to take this one step further now, and I want to really show you the importance of what we're talking about here, which is inflation benefits the investor, period. And so when we talk about the Federal Reserve Bank, my goal is not to talk politics, but the reality is the Federal Reserve Bank has benefited the investor decade after decade after decade after decade after decade. And inflation, we know, disproportionately benefits the investor. We talked about this last year as well. And why am I saying that? Because inflation means that when I go to Chipotle, I got to pay more money to buy the extra guac. That's the ultimate impact of inflation. That's the consequence of inflation. Now, when I pay more dollars to buy my groceries, when I pay more dollars to buy my Chipotle and my extra guac, what does that do? Well, some of that dollars go into the hands of higher wages, but we know that wages are don't always keep up with inflation. But the rest of those dollars go to the hands of the owners. Those are the profit. Well, who are the owners of Chipotle? It's the investors in Chipotle. It's the shareholders. And that's what we've seen happen. Incomes have not kept up with asset prices ever. I mean, if we take a look at the last 5 years, like I said, household income has grown by 18%. The S&P 500 has grown by over 90%, which means that the asset prices of the stock market have grown almost 5 times faster than household incomes. Now you might say, well, Jaspreet, that's just because of the pandemic. It hasn't always been like that. Well, let's take a look. Between 1971 to 2021, 5 decades, we saw household income rise by 600%. And I want to give you a caveat on that because household income also changed its definition, because in 1971, household income was one person's income. The man went to work and the woman didn't in 1971. In 2021, you have 2-person income households. So between 1971 to 2021, we went from 1-income households to 2-income households, and we saw household income rise by 600%. The S&P 500 between those same 5 decades has grown by 4,000%. So we talk about a wealth gap. We talk about how the rich are getting richer, the middle class is getting wiped out, and the poor is getting poorer. People use this as just like a clickbaity headline. But the reason why this happens is because of inflation. Inflation ultimately benefits the investor, and it makes the average person poorer because the average person is working to earn dollars and save dollars. Those dollars are losing value. Your salaries don't keep up with inflation, and the investors that are financially educated that are buying the assets are seeing the appreciation in the value of their assets, and they're becoming wealthier. So the people that are financially educated continue to become wealthier. Their wealth compounds. The people that don't understand this, they continue to get left out, and they don't understand why they keep struggling more year after year after year, even if they're getting a salary. It's because inflation is making your salary and your paycheck less effective. It makes it less strong. And so when you talk about, have we won the war on inflation? Did the Fed beat inflation? Absolutely not. But this is where everyone keeps talking about how the rate of inflation has fallen. But that's just one part of the puzzle.
Yeah. So now do you guys understand why I have him on here? I mean, he digs into and he provides the facts. He's not, cherry picking the doom and gloom or, all these cherry, things out here. It is what it is. And that's why I follow him. My kids follow him. They're more financial literate than I am. After I'm like, where are you learning all this stuff? And they introduced me to Jaspreet, and then I emailed him for several years, and then he's like, okay, let's do this. And so we've been connecting ever since. So thank you so much. Okay. Now on to Kyle. You got is there anything specific you'd like to ask? I feel like we have our own financial consultant right here on staff today. So thank you.
Well, I like what you're talking about in the beginning about, especially when it comes around getting into the market where a lot of people, they want to pick stock. And it really, I think what a lot of people don't realize is like picking individual stocks really is like gambling in a sense. Like you can have a good idea of what's going to happen with things, but all of a sudden a subreddit can come together and change the price of a stock. And a lot of people, I think that getting into investing means that they have to understand all the nuances and all the financial details of different companies, invest in a single stock, and then hope that it works. And so it's all this like timing, and everyone feels like I have to be a market expert to be able to make some kind of money in the market. And so what a lot of people do is they kind of throw in the towel because it's too overwhelming. It's overwhelming to think about, well, I have to do all this research, and what happens if I put all the money that I have, or I worked hard for this money to put in there, and then it tanks. Versus like what you talked about with getting into ETFs or mutual funds, or looking at a long-term approach to investing that's better. And kind of what Dan and I have noticed over the past couple months is a lot of people are treating buying their first home, the home that they're going to like live in and not be an investment, almost like choosing individual stocks, where people feel like they have to be a market expert. They have to time it right. If they get in at the wrong time, then all of a sudden they're going to be financially ruined just because they purchased a home. And I'm curious if you're seeing similar things with people who are looking at buying a house, because I'm sure if for people who are looking at investing, if they followed a lot of YouTube accounts that were talking about, you should buy Apple and you should buy Dell, like talking a lot about individual stocks, in the same way that people are talking about the housing market. A lot of people are saying, don't buy right now, wait to buy 6 months from now. It's all this like timing, I think, making people feel like they have to become these real estate experts or these market timing experts to be able to buy the house that they want to live in, not even an investment property. So I was curious if you've seen similarities to that, and then maybe some advice that you would give to people who are in that spot of they want to buy a house. Interest rates are all over the place. They're seeing home prices increasing, and they're feeling like, well, I either have to be a market expert to buy my first home, or I'm going to throw in the towel, because I think that's what a lot of people have done over the past few years is they're like, I give up. I don't want to do it. So are there similarities that you see in between the people who pick individual stocks and then are also looking at trying to time the market right for their first home purchase?
Yeah. So I'm going to talk about stocks, then I'll talk about real estate, if that's okay. So starting with stocks, one of the things I like to say is, again, you have to know your strategy. Do you want to be more of a passive investor or active investor? But there are so many ways to go about doing this, because if you're going to invest in funds, ETFs, index funds, and mutual funds, you still need a strategy. Are you investing every week, every 2 weeks, every month? And what types of funds? I mean, yeah, you can invest in the S&P 500, but you can also invest in international growth funds. You can invest in REIT funds. You can invest in healthcare funds, AI funds, tech funds. I mean, there's an unlimited number of things. So you really have to understand how involved you want to be and understand the risk that's involved there. And I just want to talk about this because we've kind of hinted at this. There's a lot that I can talk about for this, and I don't want to make that the focus of the video, but I know some people that are listening to this are probably saying, okay, well, what are the things that are going to change in 2025 in the stock market? Because we talked about, how Trump's policies are going to affect things. I'm hosting a live workshop. It's free. If you watch any of my recent videos, the link in the bio has a link to that workshop. So if you look at any of my last 3 or 4 videos, I have a link to that workshop where I'm going to be going over how Trump's policies are going to impact certain industries, sectors, and companies. But you just have to, again, you have to know your strategy and go based off of that. In the housing market, I mean, I think I'll start with the root cause, the root mistake that people make is they assume that this house that you're buying it for the purpose of building generational wealth. This house is going to make me rich. That's why I have to make the best decision on this house, because it is a generational wealth building thing. But I want to flip that a little bit, because if you look at any wealthy person in the world, they don't talk about how they became wealthy because they paid off their house. They became wealthy because they owned assets, such as real estate investments, such as a business, such as companies, such as stocks. That's what they owned. So when we believe that the house that I live in is going to be the greatest and best investment that I ever make, we start getting very financial and technical into where I buy, when I buy, how much I pay, all these little things. And then the mistake that people make is, because this is my biggest and best investment, this is where all my money should go. And that's okay for people to think that. Or people think that that's okay because I'm going to pay off my mortgage, I'm going to build equity in this house, and that's going to build me this generational wealth. And then people buy so big that they no longer have money to invest in stocks or in real estate or in their own business. And so that's the first problem, is we're looking at it like an asset, when I say you should look at the house that you live in like a liability. If it makes you money, great. But you got to remember that that house is a money pit until you sell it. Why do I say that? Because, well, you're going to need to upgrade your furnace and AC at some point. Your roof might need to be replaced at some point. Somebody might break your windows at some point. You need to pay for the maintenance and upkeep. You're going to have to pay for property taxes and insurance. You might have to pay to finish the basement. You might want to have to upgrade the furniture. I mean, there's a lot of costs that are involved in owning a house. And the house doesn't put any money in your pocket unless you sell and you make enough profit to actually walk away, pay all the realtors, pay the closing costs, and do all that. So when that's the case, I say treat your house like a liability, like an expense. Don't think of it like an asset. Now, when I think about buying a shirt, what am I looking for? Can I afford the shirt? If I can afford it and I like it, I'll buy it if I want it. If I don't like it and I can't afford it, I'm not going to buy it. So, yeah, I agree that when it comes to your house, the more important thing is, can you afford it? Period. And if you can afford it, who cares what's happening in the housing market? If housing prices crash, oh, well, you can afford the house. Keep investing your money into the markets. Use the housing crash as an opportunity to buy more rental properties, because you're buying your house to make memories. That's where the real wealth is built. And if you understand that, if you really treat your house like a liability, you're going to be much less stressed in this home buying process. And you're not going to ruin your ability to actually build true wealth through assets. But that requires some, I guess, financial soul searching and financial discipline to believe that.
Yeah.
And it's amazing how this is all full circle, because you have to have, if we can, if we can teach our kids, maybe they should teach in school how to budget and how to do just basic financial needs and things, and how to research and how to save some money, dollar cost averaging and things like that. That's when I got my first job, I wasn't making anything, but I would take like $25 a paycheck like you did, and I would put it into a mutual fund. And it's amazing over time how you look at it. You don't look at it for a couple of years, then you look at it and it's like, whoa, I got a good amount of money there. So the whole thing we're trying, and that's why I asked you on here, is just, we need to educate our youth and a lot of people just on the markets in general, how to understand that. And you're spot on when you come to all these things. I never really looked at it in the way of, your primary home would be a liability. And then, rental properties at that point, the way you defined it, would be, an investment. But your primary home, that's where you live, and again, your memories are there, and hopefully you can gain some money on that as well. So here, I'll get to this part, because this is kind of my little pet peeve on things. The housing crash. Okay, I'm still amazed, honestly, that the housing market didn't pull back as more than it did. But being in the business for, heck, this is my next month will be 36 years doing this. You start seeing a lot of these patterns, and, back in 2020 and 2021 when rates were so low, I'm like, this is going to be terrible for us in the mortgage business because long term, I'll never see those people again. If I refinance somebody at 3% on the 30-year fixed, I might see them again if they purchase another house. But a lot of people are like, I'm comfortable with my 3% and everything else. So in 2025, my expectations are once again kind of the same as I was viewing 2024. I don't see rates coming down because my feelings is, and I'll ask yours on it. When we start focusing in on mortgage rates, we saw when the Federal Reserve came out on September 18th and they cut rates, we had piles of people on the sideline waiting to refinance and also buy homes because they're like, well, the Federal Reserve is going to cut rates, so rates are going to come down. And we tried to explain it doesn't work that way. But with all the debt out there, and you have I was on the stock, the national debt ticker, and we're just like 100 billion away from $36 trillion in debt. And if you watch that ticker, it's just flying along. We have that much debt, hitting the markets at all times. Then you have corporate debt. They're going to have to refinance a lot of things. Then you have all this other stuff. Even if the Federal Reserve brought the rates down, the federal funds rate down to, whatever the nominal rate would be at this point, let's say 3.5, 4, I don't know. What is your take on mortgage rates, in the next year or two, based on the debt and everything else that we have? Even though the Federal Reserve is in their rate cut mode, I don't see really rates taking a back seat to that.
Yeah, what's interesting is the Fed cut rates and mortgage rates went up. And I think that shocked a lot of people. And the reason why is because there's more to your mortgage rate than just what the Federal Reserve Bank sets. The Federal Reserve Bank sets, like you said, the federal funds rate. That's not your mortgage rate. That's the rate that your bank pays another bank to borrow money. Now, it can influence your mortgage rate because if the federal funds rate falls, that means the bank's cost on that money falls. But another factor you want to pay attention to is called Treasury yields, more specifically the 10-year Treasury yield. And what that means is if you were to lend money to the United States government for 10 years, what type of return would they pay you? And there's a lot of factors that are going to influence the 10-year Treasury yield. But what happened was the Federal Reserve Bank came out and they cut interest rates, like you said, on September 18th. And then they said, we might not be as aggressive as we originally thought in these rate cuts. And that's where the 10-year Treasury yield rose. And that's where mortgage rates then went up as a byproduct. And the reason why the 10-year Treasury yield affects mortgage rates is because your bank is an investor. Your bank is, when they lend you money, they're investing money into you. And so they have to compare their options and look at risk versus reward. I'm not trying to be rude, but you are a riskier investor than the United States. You are a riskier investment than the United States government. So when the bank now compares, who are we going to lend this money to? On one hand, they look at the government, the 10-year Treasury yield, which historically has been known as a risk-free investment. And we know that lower risk, you should get generally lower rates of return. So if the 10-year Treasury yield is the risk-free return, lending money to you is a risk-y return. It's risky. So I need to charge you a higher interest rate as a bank, because otherwise I would just lend my money to the government and not take on any risk. And that's where now you want to pay attention to this 10-year yield, because when the Fed cut interest rates and investors heard that the bank might not be cutting interest rates as fast as they thought, investors then got scared and they wanted a higher rate of return from the government. The 10-year Treasury yield went up, and then mortgage rates went up with that too. And so this is where, when we take a look at where is it going to go, the Federal Reserve Bank is going to be pressured by Trump to cut rates. They are supposed to be an independent entity. They're called the Federal Reserve Bank, although they're not a bank. You and I can't go there to deposit money. They're not a reserve. They don't sit on cash reserves, and they're not federal. It says so on their website. They're supposed to be independent. But we all know that sometimes they can be influenced by who's in the White House. Now, Jerome Powell, who's the chairman of the Federal Reserve Bank, has said that he's not going to change his plans based off of Trump's policies or based off of what Trump says. Trump says he wants big interest rate cuts in 2025. Now you can start to see that there's a little bit of a butting of heads here because Trump doesn't get to decide interest rates. The Federal Reserve Bank does. Trump can't necessarily fire the Federal Reserve Bank very easily. I mean, yeah, there are ways to do it, but it's not a very direct path. So now the question is what is going to happen next? Because you bet that there's going to be some political pressure from the White House on the Federal Reserve Bank to potentially cut interest rates more aggressively. And that's where there's a lot of uncertainty as to what's going to happen. We know that Jerome Powell is going up for re-election, or sorry, his term ends in 2026. So when that comes around, will he be reappointed or not? Will Trump actually entice him to cut interest rates or not? We'll see what happens there. But what Jerome Powell has said is that unless there's a change in the economy or inflation, he's not going to change his plans. And what that means is if we don't see a recession, he's going to stay on his course. And you can start to see now the little bit of a dilemma here because on one hand, we keep hearing that the economy is booming, unemployment is super low, and inflation is not a problem. If that's the case, why do we need to keep cutting interest rates? I mean, why are we cutting interest rates in the first place if inflation is supposedly not a problem? If unemployment is supposedly still some of the lowest we've seen in the last 50 years? I mean, 4.1% unemployment is still some of the lowest we've seen in decades. Yeah, it's higher than we were last year, but historically it's very low. So what are we stimulating? And that's where it's just confusing because you hear that the Federal Reserve Bank is stimulating because inflation is not a problem and they want to stimulate the job market. Well, if inflation is not a problem and the job market is at some of the best numbers we've ever seen, supposedly, why are we cutting interest rates in the first place? And it's to continue stimulating this economy, which has a lot of cracks in it. And that's the concern.
Got it. So are your thoughts on, because I like I said, I've been a proponent of, when I saw mortgage rates go to 8, our basically our phones shut down. But the unique thing behind this one was, not a lot, well, because people had, such low rates and so much equity in their homes, they don't have to sell. They're not forced to sell. So I'm still thinking that's the biggest proponent because, you look at all the statistics, people that have owned homes, they have a good amount of equity in it. So you're not going to see forced selling through foreclosures or things like that because you have the equity. And that's what I said. I said, I don't see the foreclosure market picking up. Like I have a lot of data internally here at the bank that I can't divulge, but, delinquencies aren't bad. They're ticking up a little bit, but historically they're still really low. So this cycle versus the 2008 cycle, at that point people were forced to sell their homes or foreclose or just walk away. How many keys for cash? I never heard that term until 2008. People are just walking to the bank and just giving give them keys over to the bank saying, here's the keys, you can have the house. In today's market, you don't have that because of so much equity in the market. That's why I've been a proponent, and I've pissed off a lot of people on YouTube. I'm saying I don't see a crash, I don't see a crash coming. Now, a correction in some areas, specific areas, yes, but an overall national crash like we saw in 2008 and so forth, I don't see it. Am I missing something?
No, I think we're very far from that. I mean, I think what you said is 100% right. In order for a crash to happen, number one, people can't make their payments. And then number two, people can't sell their houses. We're not in that situation today. Number one, people are still able to make their payments because many people have a fixed rate mortgage, unlike 2008, where it was variable interest rate mortgages. So that's the first part that's different than 2008. And the second thing is, if you do lose your job and you are unemployed for a prolonged period of time, chances are you can sell that house and walk away with a pocket full of cash. It's a very different situation. Now, can things change in the future? Sure. But in order for that to happen, we need more supply. And in order for us to have more supply, we need to have either people sell their homes or B, we need to build more homes. And building takes time. And we know that there's a shortage of inventory still. It has gone up. The number of inventory, the amount of inventory for sale has gone up, but it's still short. So yeah, I mean, I'm not so worried about that housing market sudden crash. I do think that there's room for a correction in many markets. I mean, we've seen rental rates actually fall
Right.
in
Yeah.
many areas. If that's any indication of maybe buyers just can't keep affording the higher prices, but if you start cutting mortgage rates, well, then maybe we can start paying a little bit more for the housing price again. And so it's a there's a lot of things at play here. We don't have the same risk factors for the housing market, but I think we have more risk factors for the economy. And I think that's the difference between now and 2008. 2008 was a house of cards in the housing market, which then trickled down into the rest of the economy. I think we
Yeah.
have a lot of broader risk factors in the economy, which could impact the housing market, but it's not a housing market issue per se.
Got it. I loved your comment about the shirt. If the shirt's too expensive and I don't want it, or even if I do want it, I can't buy it. So I do feel bad for people getting into the market right now, trying to buy that first home. We're here in Chicago. Taxes are sky high, like you said. Insurances are up 50%. All this other, it's difficult for somebody to get into a starter home. But I think a lot of it too is, I don't know how old you are, but I'm on my third house, and I grew up in that generation where you bought a small little house, the tiniest thing you can make those payments on, and you lived there for a while. And I paid the mortgage down and so forth. Then I sold it, took a little bit, my profits, and rolled it to the next house. And now I'm on my third house, and it's the house I really love. And I think a lot of people, when they're comparing things, they're comparing their 1 or 2 bedroom apartment, and now they want to buy a house that's 3 or 4 bedrooms, 2.5 baths, 3-car garage, this, that, and it doesn't add up. But also things are expensive, so you feel bad for those, the younger people trying to get into housing. This is the area I can't come up with a solution. What, like you were saying, what's really the solution? Even if rates come down somewhat, you still have the lock-in effect for rates. Building permits they're not blowing out the doors. So you're not having a huge amount of new inventory coming to the market. And then the new inventory coming is a lot of, built for rents and multi-unit buildings and so forth. What is the outlook? Is there a rosy picture at all for people, younger people to get into housing, now? I know it's
Yeah,
a kind of a broad question, but you get my gist.
yeah, I think there always is. It's just you got to be creative, and I think that's the difference. There's always an opportunity for those that are creative, and that opportunity is always going to be changing. I mean, if you come to Michigan and you want to buy a house and you don't have a ton of money, well, guess what? I can show you a house today, many houses in good neighborhoods, growing areas, cool cities, cool downtowns, growing populations, growing businesses, 3 bedrooms, 1.5 bath, maybe even 2 baths for $200,000, ready to go. If you go to Manhattan, you need $2 million to buy a shed. And so it's,
Yeah.
you have to be realistic with where you are. And I mean, I'm just gonna be frank. I mean, I love the city of Detroit. I love Michigan. So I'm gonna be a proponent here. You're not gonna make that much of a different salary between Manhattan and Detroit. I mean, it's not that much of a difference. Let's just call it a 10% different salary. Or if we want to be generous, let's call it a 20% difference in income. But your cost of living is significantly different. It's not even comparable. I was in Los Angeles up until a couple of days ago, and I was there for a couple of days, and we went out to breakfast, and I got my wife got an avocado toast. It cost $30 for the avocado toast. If you wanted an egg, it was $3 for one egg. And so I look at that
Wow.
and I said, wow, that's a lot of money. Because if I go to Detroit, I can get that same avocado toast for $10. I go to a fancy restaurant, maybe 12 or 14 if it's a high-end restaurant. But we're
Yeah.
talking half the price. Now, when you compare now the full cost of living, which is, yeah, you got food, you got eating out, but then housing costs and income taxes and property taxes and insurance rates and everything else. I mean, you can start to see where it's so expensive. And I mean, California is a beautiful state. Manhattan is beautiful. I love Manhattan. But it is freaking expensive. And, it's like, if you can't afford it, why are you there? If you're there because you're a creative and you're going to make it and you want to hustle, and that's fine. I get that, right? There's an opportunity for some people to you go there and you're going to live in a closet because you have a dream and you're working for something really hard. I'm behind you. But if you're one of those people that just says, yeah, I like the city, and now you're making $50, $60, $70,000 a year, and your expenses are $80,000 a year because you want to live in Manhattan and you just want to work a regular job, you are fooling yourself. Go out, move to Michigan for 5 years, bust your butt, save some money, grow your income, grow in your career, build some investments, build some savings, and then move there. So I think you have to be creative. And, we have actually, interestingly, seen a number of people move to the state of Michigan from more expensive areas because of the very reason. I mean, it is expensive everywhere, but there are pockets of the country that are nice, that are growing, that have cool places that you can buy a house for a lot cheaper.
That's why I try to say that every once in a while, because we'll get a lot of applications from people out in California, and they're younger people looking to buy, and they'll send you some things over, and it's like it's $650,000 for that, and then you're struggling to make it fit, and I'm like, I can't get you to budget, and they get, well, what am I supposed to do? It's like, and you hate to say it this way, but it's like, move, but, or you're never going to buy a house. Like you just said, if you live in LA and you make 60, 70 grand, you're never going to buy a house. Okay. Just face it, but don't get ticked off about it. I guess that's probably the way just to put it. You have to, live in your environment, I guess is the best way to put it, or where you could afford. So great take on that. I don't know how much time we got going. So I don't want to take your whole day, but I love having you here. I can ask you questions. I would love to come and visit you sometime. I'd treat you to dinner and I'll ask you questions all night long. So I got that, got the Fed, got mortgage rates, got housing. Okay. Last but not least, do you think this crypto stuff's still going to go up? Crypto and AI, it's driving me kind of bonkers. Is there a kind of a brush you can just paint across it? When I first got into Bitcoin was about 5-6 years ago. And my kids were, my oldest son was way into it. He understands it. He's an engineer, and we broke it down. I'm like, this is pretty interesting. I thought Ethereum was a better platform for me to invest at that time, so I did. And then since then, he asked me to start just dripping some money into Bitcoin, and I did. I started putting into that BITX because I'm like, this is just play money. I'm putting it there. I either want to make a killing or I don't think I'll lose it all, but I might lose it all. And it's paid off very well. Is there a future for these cryptocurrencies in our economy today, and are they viable? Are they a viable investment? I guess would be my only question there.
Yes.
And let me answer. I'll ask you one more thing. Just this. Here's what I didn't understand. They said it was a hedge against inflation. And that was one of the reasons why I got into it, because I'm like, inflation's going to, back during COVID, I'm like, inflation's going to run crazy because we got all this money being pumped out there. During that time, I was on several YouTube videos with people. I'm like, guys, right now we have a mortgage moratorium, or forbearance. You don't have to make a mortgage payment. You don't have to make a student loan payment. During COVID, the government was pumping out tons of money. A lot of people still continue to have their job. I'm like, okay, this is why you have inflation. You got way too much money chasing too few goods. So that created the inflation. But then you saw Bitcoin, plummet at one point, and I'm like, okay, I thought this was a hedge against inflation. So I'll just tee it up at that. That'll be my last question.
So I'm just gonna let you know, I'm gonna upset a lot of people with what I'm about to say, but I don't say what I say to make friends. I speak to help people be better with money. I got involved with Bitcoin, not super early, but the 2016-ish, 2017, I bought quite a bit when it was between $3,000 to $3,500 a coin. That's when I started buying. And I did sell a big chunk of it when it was in the low to mid 70,000, low 70,000s. So I made a pretty big profit. And the reason why is because, well, when I buy that Bitcoin and it goes up 2,000%, which is where my portfolio was, I don't actually make any money. And now there's a few scenarios. Bitcoin could go up to 250,000. It could 4x. Maybe it could go to 1,000,000. But it could also fall. I mean, I've seen over the last, 5, 6, 7 years of Bitcoin that it rise and fall many, many, many times. I mean, I remember the crash from $20,000 a coin down to $3,000 a coin, and people lost their minds, and I was still buying during that time. And I've seen that many times. And so I was like, well, when I plan my portfolio, right? I have real estate is my largest, is about 50% of my portfolio. Then I have stocks, it's about 30% of my portfolio. Then I have my speculative, which is about 18% of my portfolio. And then I have 2%, which is physical gold. Now, the speculative piece, inside of that is where I have startups and I have cryptocurrency. So now I buy this cryptocurrency and it shoots up in value. And now the speculative piece of my portfolio kind of just starts to balloon because now I have this cryptocurrency that has really grown a lot over the last number of years. So I wanted to take some off the table and move that money to something into cash flow, into real estate that's going to pay me with cash flow, because guess what? Now I can turn that into a new income that I can use. Well, what we're seeing today is a lot of people excited because a few things. Number one, Trump has been more pro cryptocurrency. Number two, Trump has talked about firing the current SEC chairperson, Gary Gensler, who is not a big crypto fan. And he wants to hopefully replace him with somebody more pro crypto. And so there's been a lot of excitement. But let me tell you now my thoughts here. Crypto is a speculative investment, period. Has it been a hedge against inflation? Yeah, I mean, if you look at it over the long term, but not a direct hedge. I mean, we've seen gold be a better direct hedge, that when people are worried about inflation, gold goes up. Bitcoin has been more volatile. I mean, we've seen Bitcoin move in opposite directions as inflation and or gold. So Bitcoin operates more as a speculative asset for that. I do think that there is a place for cryptocurrency and blockchain, which is why I still own it. But I think that there's a lot of people that are buying it because they want to get rich quick. And I think that's where bubbles get created. And we've seen that happen time and time and time and time again with cryptocurrency, particularly. Yesterday, and I'll show you why I mean. My dad calls me, or actually I was with my dad. I sat down with my dad. And he starts talking to me about Bitcoin. And he asked me, how do I buy Bitcoin? I said, well, why are you asking? He said, oh, it's going to go up so much. I said, why do you say that? He said, Trump's going to make Bitcoin go up a lot. And so my dad, who is not very involved, in this financial space, is saying that he wants to open up a Coinbase account to buy Bitcoin. He didn't know where to go, where Coinbase is, or can he buy it on his stock brokerage? What can he do? And so I talked to him about it, and he was telling me how it's going to go up a lot. And you have to imagine that there are a number of people that are buying it for that reason. Now, again, it's not bad to own Bitcoin or cryptocurrency, but let me tell you why that creates concerns. It creates concerns because then you have a lot of people who don't understand it, who have no idea what cryptocurrency is, who buy it because I want to get rich quick. And I want to get rich guaranteed because that's what's going to happen. And so when you have a lot of those people that end up buying, and then a lot of platforms make it very easy to buy with margin as well, meaning debt, that then creates a lot of exuberance, a lot of euphoria. And if and when we start to see a correction in cryptocurrency prices, it's not a matter of if, it's a matter of when. I mean, it happens in every asset class. Real estate prices see corrections. Gold prices see corrections. Stock prices see corrections. Cryptocurrency is the most volatile of all. When you see a correction there, you have to imagine that there's going to be a percentage of people who will not understand why it is falling, because I thought Bitcoin was only supposed to go up. You have a limited supply of Bitcoin. You have the president that's going to make Bitcoin the currency of the world and blah, 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 blah. There's a lot of euphoria that happens. And then you see a correction and then people panic, especially if they have debt. And so this is where, I want to make this very clear. I'm not against buying cryptocurrency. I'm not against buying Bitcoin. To me, it is a speculative investment. And so if it's a speculative investment, treat it like that in your portfolio. 80% of my portfolio is real estate and stocks. 18% is speculative, 2% is gold. Out of the speculative, some of that is cryptocurrency. That's the way that I do it. I don't recommend what I do to anybody else because I'm just a random guy on YouTube. You got to figure out what's right for you. You have a different risk tolerance. But the reality is speculative investments are speculative. They're risky. You can see it go to the moon or you could see it crash. When I invest in a startup, I know that this startup that I invest in could be worth a whole lot more money. It can also go bankrupt. I've invested in a number of companies that have gone bankrupt or close to. I mean, it's a risk. And that's where you have to understand how it plays a part in your portfolio. Again, I believe that there's a real value in the blockchain. I think there's a lot of value in that. But I also understand how financial instruments work. And I also understand that people are emotional. They can be greedy. They can be fearful. And I know how those emotions play out in financial cycles. So, I think there's a lot of opportunity with it. I think some people are going to make a lot of money. I think some people are going to lose a lot of money. But if you understand the way that the system works and you cut out the emotion, you'll find the ways to make money.
Awesome. Somebody just gave you kudos up there. It says, son teaching his dad a lesson. The tables have turned. So you're talking about your dad. So, alrighty. That might do it for us for today. Are we pretty much close to time?
Thank you so much for joining us. And do you have one more thing, Dan?
No. So Justpreet, what we'll do in the bottom of the description, we'll have all the links to your stuff, your YouTube channel, your newsletters, and all the other stuff you have. So if you guys would just check our live stream maybe later this evening, we'll have all that updated for you down there. And please check out Justpreet's live events. They're fantastic. I watched them as many times as I possibly can because I want to learn. You understand now why I have him on the channel. He just tells it as it is. He tells you the basics. Kind of like he should be an econ teacher or professor. I think he'd do very well. So thank you so much again, Justpreet, for being on here. Hopefully next year, God willing, we'll both be on this earth that we can get together once again and maybe put out a 2026 forecast. But I'll be driving you nuts in your email every month just to check up on you, make sure you and your family are doing fine. And I can't thank you enough for coming on with us. It is a true pleasure.
Thank you, Dan. It's an honor to be on, as always. Thank you for having me on. It was really a pleasure. And thank you, everybody, for your time, for listening. I really appreciate that. It really means the world.
Awesome. Thank you all.
And thank you.
We'll see you next week.